Welcome to Chart of the Day. I'm Robert Folsom. Trade war. Who or what may be the biggest casualty? Trade wars can be thorny. The scale of the economic disruption can escalate quickly, and much like real wars, trade wars are easier to begin than they are to end. And here we offer a big picture perspective to consider what the biggest casualty may be in the trade war that's in the headlines right now. And this is a different perspective than what you'll see elsewhere. We begin with the U.S. stock market, yet this is not a major index like the Dow or S&P. Instead, it's a ratio of U.S. stock market performance relative to the performance of world stock markets. Note that this long-term look goes from 1970 through July of this year. So what does this have to do with trade or trade wars? Well, Murray Gunn, an economist and EWI analyst, explains that U.S. stocks relative to world stocks is a proxy for capital flows, that is, money moving to and from the U.S., which absolutely can be disrupted in a trade war. Capital flows also have a loose relationship with the U.S. dollar. And here's what that looks like. This red line is the U.S. dollar broad trade-weighted index, or the dollar's value against a large basket of global currencies. It's along the same timeline, and we can highlight two periods which include U.S. stocks underperforming and a weaker dollar. One, in the second half of the 1980s, and two, most of the decade beginning in 2000, which included two large bear markets. Both of these graphs show U.S. stocks and the dollar moving mostly higher over the past decade. What the casualties will be after a change in these trends speaks for itself. Please see below for more.